Every age has its peculiar, folly-some scheme, project, or fantasy into which it plunges. That's Charles Mackay, writing way, way back in 1841.
In Extraordinary Popular Delusions and the Madness of Crowds, yeah. Amazing book.
It really is. And he talks about being spurred on either by the love of gain, the necessity of excitement, or the mere force of imitation. And, when you look at the U.S. stock market in the 1960s, the go-go years, it feels like he was describing that decade, centuries early. It just fits so perfectly.
It really does. He totally nailed something universal about markets and, crowd psychology. And the 60s market, prime example.
Yeah.
All those things Mackay mentioned, gain, excitement, imitation, they were all there, converging.
Yeah, a real period of what he called mania and exuberance.
Absolutely. Classic case.
And the aftermath. Well, it was pretty brutal for the stocks that defined that era. There was this financial consultant, Max Shapiro. He put together this sort of handmade index back in 71, tracked 30 of the big glamour stocks of the time.
Right, the leaders of the pack.
Exactly. And the results for the 69-70 period, just devastating. Conglomerates, on average, down 86%.
86.
Computer stocks, down 80%. Tech stocks, down 77%.
So across the board, basically.
Pretty much. The average decline for all 30 of these supposedly amazing stocks, an incredible 81%.
81% average drop for the darlings of the boom in just, 2 years?
Yeah.
That really tells you how far things fell, how extreme the prior peak must have been.
81%. I mean, that's almost complete annihilation for some investors. So the big question we're tackling in this deep dive is how? How did investors get so utterly swept up in the hype, the optimism of the go-go years, chasing these returns that, ended so badly?
What was really going on under the hood?
And what happened when the music finally stopped?
Exactly. We're diving into the U.S. go-go years, the 1960s stock market, framing it as, a time of genuinely exciting growth in some areas.
Sure, some real innovation was happening.
Definitely. But also, alongside that, intense, almost irrational speculation in a lot of stocks.
And we've got some great sources to guide us. Those classics on market psychology and history. Mackay, obviously. John Brooks's book on the era of the go-go years, which is fantastic.
Oh yeah, essential reading for this period.
And Robert Shiller's Irrational Exuberance, bringing in the historical data and the analytical frameworks.
Shiller's work is crucial for understanding these cycles.
Plus, we're pulling in some more recent discussions that kind of reflect on why this period still feels so relevant today.
Right. So our mission here is pretty straightforward. We want to unpack this stuff, really understand the dynamics of the go-go years, what set the stage, what drove it, who the market darlings were, this delusion around valuation.
Yeah, the idea you could pay anything.
The crash itself, and importantly, the behavioral side, what was going on in people's heads.
And the goal, ultimately, is to pull out those timeless lessons about growth, speculation, investor behavior, things that aren't just history, but are super relevant for you trying to navigate markets today.
Couldn't agree more.
Okay, so let's set the stage. What were the conditions? What created this environment where market exuberance could just take off like that in the 60s?
So like we said, Mackay's mania and exuberance really captures the feeling. There was this sense in the air, this feeling of new frontiers, excitement. It really pulled people in.
A palpable buzz.
Yeah. The sources describe it as a time when that love of gain was particularly strong, maybe combined with the necessity of excitement, perhaps pushing back against other things going on in society.
Interesting point.
And definitely the force of imitation. Seeing your neighbor getting rich, you want in too, right?
The fear of missing out, even back then. Yeah. So it wasn't just cold, hard analysis driving decisions. There was a big emotional, social wave.
Absolutely. And this wave wasn't random. It focused very intensely on certain types of stocks, the famous market darlings of the era.
Okay, like what?
Probably the most famous group was the Nifty 50. These were large cap growth stocks seen as just unshakable. Their growth was considered so certain that, the belief was you could pay almost any price for them.
Right, the one decision stocks. Buy them and forget them.
That was the mantra. And alongside those established giants, there was this huge fascination with the future, with technology, often just lumped together under this cool futuristic label, Tronics companies.
Tronics, yeah. Sounds a bit dated now, but back then...
Back then, it was cutting edge. Electronics, computing, automation. It must have felt like science fiction turning into reality.
And that promise, that excitement, it fueled incredible optimism, maybe blurred the lines between what was realistic and what was, pure hope.
I think that's fair to say. And another big trend capturing investors' imaginations was the rise of the conglomerates.
Ah, yes. These massive companies built by merging totally different businesses together. Litton Industries, Gulf and Western, Lingtem Kovat. Those kinds of names. What was the appeal?
Well, the pitch was often about synergy or diversification. Combine different businesses, make the whole greater than the sum of its parts, smooth out earnings, that kind of thing.
Sounds good on paper.
Sometimes. But often it seemed driven more by, let's say, aggressive accounting or just the thrill of rapid expansion through acquisition. And for a while, the market completely bought the story.
So you had the invincible growers, the Nifty 50, the exciting future tech, the Tronics, and these sprawling empires built by deals, the conglomerates. That covers what people were buying. But you mentioned how people invested also changed.
Massively. This brings us to the boom in mutual funds. It's hard to overstate how much the mutual fund industry transformed during the go-go years.
Because before the 60s, they weren't really a big deal for the average person, were they?
Not at all. They've been around since the 20s, but for decades, it was a pretty sleepy business, mostly for the uber elite,
Right.
managed within old money circles, Ivy League connections.
Right.
The sources point out, by 1954, despite being invented 30 years earlier, there were only about 100 mutual funds total. Not exactly mainstream.
And the 60s blew that wide open.
Totally. The 1960s is when mutual funds really hit the mainstream, became a way for the general public to get into the stock market easily. And a huge part of that was the rise of the celebrity fund manager.
The rock stars of Wall Street.
Pretty much.
Yeah.
And an absolute poster child for this, the guy we were talking about, the de facto Pied Piper, was Gerald Sy.
Gerald Sy, okay.
Ken Fisher even calls him one of those flamboyant go-go fund gunslingers who just captured the whole spirit of the era.
So people weren't just buying the fund, they were buying the manager, his genius, his track record.
Absolutely. Sy's performance became the story. He managed the Fidelity Investments Performance Fund, created in '57, one of the first really aimed at the broader public. And look at the growth. That fund's assets under management, its AUM, grew, wait for it, 27-fold in 8 years by 1965.
27 times bigger. In 8 years.
Yep, 27-fold.
That's just a tidal wave of money. Ordinary people pouring their savings into these funds, chasing the hot hand, chasing size returns.
It shows you the scale of public participation and the sheer power of performance, or maybe just the perception of performance, to pull in capital back then. People saw the numbers, heard the stories about Sy, and they just wanted in.
Okay, so we have this picture. Incredible optimism, excitement about tech and conglomerates, new ways for the public to invest easily, led by these charismatic star managers. But you hinted earlier this wasn't happening in a vacuum. It wasn't exactly peaceful times.
Far from it. And this is one of the really fascinating paradoxes the sources bring up. This period of intense market hype was happening while the market was, as they say, scaling the wall of worry.
The wall of worry, meaning the market kept going up despite some pretty big reasons for concern.
Exactly. The 1960s in the U.S., it was a time of extreme social strife. You had the civil rights movement at its height, widespread protests, riots in cities, deep internal divisions and challenges.
And globally.
Also incredibly tense. Extreme geopolitical tensions driven by the Cold War, proxy wars, the constant threat of nuclear annihilation, Vietnam escalating massively.
Right, huge anxieties.
These were massive existential worries hanging over everything.
So you've got this roaring stock market fueled by tech dreams and growth stories, while the country's grappling with major social upheaval and the world's on edge with the Cold War. It feels disconnected. How do you square that?
Well, it's just market sentiment isn't always a simple reflection of the 6 o'clock news, right?
Right.
Or maybe the lure of big financial gains and this revolutionary tech story was just so powerful, kind of overshadowed those other worries for a lot of investors, at least for a while.
They were focused on the upside, not the potential global or social downside.
And it seems like it. They were focused on the story the market was telling them.
And when you list that whole combination, the social issues, the Cold War tension, the tech optimism, the mutual fund boom, the celebrity managers, the speculative behavior, the sources make this point about eerie similarities to our current world.
And that's exactly why digging into this isn't just history homework. Understanding how the go-go years played out, the dynamics, the psychology, the crash, offers really valuable insights for you today. Because our world also feels like it has that mix of exciting tech change alongside pretty significant social and geopolitical uncertainty, doesn't it?
It really does. A reminder that the wall of worry is maybe just always there.
Okay, let's shift gears. Let's talk about the core problem, the thing that ultimately brought this era crashing down. What was the fundamental delusion, as Forbes called it? Yeah, Forbes magazine really nailed it when they looked back at this period. They zeroed in on the absolute heart of the problem.
What'd they say?
They wrote, and this is key, the delusion was that these companies were so good, it didn't matter what you paid for them. Their inexorable growth would bail you out.
Oof, it didn't matter what you paid. Knowing what happened next, that's chilling. It's a total rejection of basic valuation, isn't it?
Completely. Just pure faith in growth. Growth at any price. And Forbes didn't mince words about who was responsible. They said, obviously, the problem was not with the companies, but with the temporary insanity of money managers, proving again that stupidity well packaged can sound like wisdom.
Stupidity well packaged can sound like wisdom.
Oh, wow, harsh. So what was this well-packaged stupidity specifically?
It came down to the multiples. The price-to-earnings ratios people were willing to pay. Forbes had a very specific warning. It was so easy to forget that no sizable company could possibly be worth over 50 times normal earnings.
50 times earnings. Just for perspective, historical average PEs are often what, mid-teens? Maybe low 20s sometimes? Paying 50, 60, 80 times earnings? You're assuming truly insane decades-long growth just to break even on the current earnings power.
You're basically pricing in a perfect, flawless future. And like Forbes said, the issue wasn't always the companies themselves. Some were genuinely innovative, growing fast.
The problem was the price people paid for that potential. The temporary insanity was believing price just didn't factor into the equation anymore because growth was somehow guaranteed.
And we saw the results in the Max Shapiro Neo-Dow index you mentioned. His attempt back in '71 to create a benchmark that actually reflected these glamour stocks everyone was chasing.
Yeah, he saw that the traditional Dow Jones wasn't really capturing this new breed of high flyers, the tech and growth names.
So he made his own list of 30 big ones, remind us of the breakdown and the carnage.
Right. He split them into 3 groups of 10. First, 10 leading conglomerates, Litton, Gulf and Western, Temco, Vought, those types, empire builders.
Okay.
Second, 10 computer stocks, IBM, obviously, but also others like Liasco, Sperry Rand, the dawn of the computer age.
Got it.
And third, 10 technology stocks, names like Polaroid, Xerox, Consumer Tech, but also industrial players like Fairchild Camera.
So these were the poster children of the go-go promise. And when the music stopped.
For the conglomerates, the average decline from their peaks in that 69-70 crunch was 86%.
86%. Just think about that. Losing almost 90 cents on the dollar.
On average, across those 10 leaders, in just 2 years.
Unbelievable. What about the others?
Computer stocks, only slightly less bad, an average decline of 80%.
80%, still catastrophic.
And the technology stocks, the beloved Tronics, they averaged a 77% decline.
So it didn't really matter which flavor of hype you bought into, conglomerate, computer tech. The end result was pretty much the same. Utterly devastating.
Leading to that overall average decline of 81% for Shapiro's whole list of 30. It's just the starkest possible proof that, yes, it absolutely mattered what you paid.
Definitely mattered. And this wasn't just one big crash right at the end of '69, was it? The sources say there were warning signs earlier in the decade, too.
That's right. The market wasn't just a one-way street up. It had already punished some of this overvaluation during the go-go years. The Tronic stocks and other high-growth names, for instance, they had a pretty nasty crash earlier on, back in late 1962.
So like a mini crash within the larger boom?
Kind of, yeah. A sharp reminder that valuations could get ahead of themselves and get corrected, even within the overall bull run. And then the computing stocks, they had their big crash later in the decade, which fed into those terrible 69-70 numbers Shapiro tracked.
So it was bursts of speculation followed by these painful corrections.
Exactly. Not a smooth ride up at all.
Given how bad these drops were, especially the final 81% average decline in Shapiro's list, how did the speculation get so out of hand? Were people just ignoring flashing red lights? Were there any warnings?
Well, funny you should ask. The sources mentioned that in some cases, the warnings were incredibly, almost comically explicit, like actual warning labels on some of the riskiest stocks being sold.
Wait, like a Surgeon General's warning on a cigarette pack, but for a stock, what did it say?
The example given is something like, warning, this company has no assets or earnings and will be unable to pay dividends in the foreseeable future. The shares are highly risky.
You're kidding? They literally put that on the share certificate or prospectus. This thing is basically worthless and super risky,
Apparently so.
and people still bought it.
The fact that such a label could even exist and that shares carrying it were presumably still traded just highlights the intensity of the speculative fever. It clearly wasn't just about rational analysis anymore.
No kidding. It was pure gambling, hoping to flip it to someone else before the music stopped.
It seems like raw excitement, imitation, maybe just greed, completely overwhelmed any sense of caution or fundamental value for some participants.
It's almost baffling. The numbers, the warnings, none of it seemed to matter against that speculative tide.
And that brings us back to those other factors, beyond just the numbers. Like the rise of mutual funds and those celebrity managers we talked about. They really poured fuel on the fire.
How so? By bringing more people in, changing the focus?
Yeah. Both, I think. That transformation of mutual funds from this niche elite thing to a mainstream product, well, it created the plumbing, didn't it? It channeled huge amounts of public money into the market, and specifically into these high-flying growth and tech names.
Money that maybe wouldn't have found its way there otherwise.
Possibly. Before, maybe you needed more capital, more knowledge to buy individual stocks directly. Mutual funds made it easy for the average person to get exposure, pooling money from millions of small investors.
And Gerald Sy, the Pied Piper, was the face of this new era.
He really was. His incredible success with the Fidelity Performance Fund wasn't just about pulling in assets, though that 27-fold growth is staggering. It also popularized this aggressive growth style of investing. It made the fund manager a public figure, a star.
So people felt like they were buying his magic touch.
Yeah, buying into his perceived skill, his hot hand. It created this powerful feedback loop, didn't it?
Yeah.
Great performance attracted more money,
Right.
which likely helped push up the prices of the stocks the fund was buying,
Which made the performance look even better.
which attracted even more money, and so on.
A self-fulfilling prophecy almost.
To some extent. This flood of public money, often guided by sentiment around these newly famous managers, added a whole new layer to market dynamics. Narrative and momentum became incredibly powerful forces, sometimes completely detached from underlying value.
This all seems to connect really well with Robert Shiller's work, looking at market history and valuation peaks.
Absolutely. Shiller's analysis in Irrational Exuberance gives us a great lens for this. He often uses metrics like the price-earnings ratio, the PE ratio, to gauge how expensive the market is. The source here uses a specific version, the real S&P index price, divided by the 10-year average of real earnings.
Okay, so using a 10-year average for earnings smooths out the bumps, right? Gives a better sense of long-term profitability compared to the current price.
Exactly. It avoids getting thrown off by one unusually good or bad year for earnings. And using this smooth PE measure, Shiller identifies the go-go year's peak as the third major one he discusses historically, following earlier ones around 1901 and 1929.
And when did the 60s peak happen, according to his data?
January 1966. That's when this particular PE measure hit a local high of 24.1.
24.1. Still sounds high compared to long-term averages, even smoothed out. How did the market climb that high?
Well, it followed a pretty strong bull run leading up to it, specifically a 5-year price surge from May 1960 of 46%. But here's the important part. During that same 5-year period, earnings also surged by 53%.
Okay, wait. So unlike those warning label stocks with no earnings, the broader market did have strong earnings growth leading into the 66 peak. Prices were going up, but profits were going up even faster.
Initially, yes. That initial surge had a real fundamental basis in earnings growth. But, and this is Shiller's crucial point, the market didn't just react to the growth that had happened. It reacted as if it expected the growth to continue at that blistering pace.
So prices got bid up way beyond the current reality, based on extrapolating that 53% earnings growth far into the future.
That's the interpretation. People assumed the good times, the rapid earnings growth, would just keep rolling indefinitely. Not even close, Shiller puts it bluntly. Real earnings increased little in the next decade after that 1966 peak. That engine of earnings growth that had justified the earlier price rise just stalled out.
And if your high stock price is built entirely on the expectation of continued rapid growth and that growth disappears,
the foundation crumbles. The high valuation suddenly looks completely unsustainable. And the aftermath of that January 66 peak is just one of the starkest lessons from this whole period when you look at Shiller's data on what happened next to investors.
what did happen to the market after hitting that PE peak?
Well, real stock prices, inflation-adjusted prices, they didn't immediately crater across the board. They kind of bounced around near their January 1966 peak, even nudged a bit higher in 68, but then fell back. They just couldn't sustain that level.
Okay, so not an instant crash, but stagnation followed by a fall.
A significant fall eventually. By December 1974, real stock prices were down 56% from their January 1966 value.
Down 56%. That's losing more than half your purchasing power in about 8 years if you bought at the peak. Ouch.
It's bad. But the recovery time is maybe even more shocking. It really drives home the long-term cost of overpaying. How long do you think it took for real stock prices just to get back to where they were in January 1966?
Based on that 56% drop, maybe?
10 years?
15.
Try May 1992?
1992. From 1966. Hang on. 26 years?
26 years. A quarter a century. If you bought the broad market at that PE peak in early 66, adjusted for inflation, and held on through everything, your investment didn't even regain its initial real value for 26 years.
That is just mind-blowing. 26 years of zero real return. It utterly destroys that idea that it doesn't matter what you pay because long-term growth will save you. The starting price killed returns for decades.
And the average annual returns show it clearly. Following that Jan 66 peak, the average real annual return, dividends included, was negative 2.6% over the next 5 years. Negative 1.8% over 10 years, negative 0.5% over 15 years. Even after 20 years, the average real return was only 1.9% per year.
1.9% after 20 years. Compare that to the kind of wild optimism that must have been driving prices in 65, 66. People weren't buying for 1.9%, they were expecting fortunes.
It's just a powerful historical lesson about the danger of buying into markets when valuations get stretched way beyond historical norms, even if the underlying economy isn't necessarily collapsing right away.
Shiller also mentioned another classic warning sign in the data, didn't he? Dividend yields.
Yeah, he points out that historically low dividend yields compared to stock prices have often preceded periods of poor returns. It's that simple wisdom, he calls it, that when one is not getting much in dividends relative to the price one pays, it is not a good time to buy stocks. And he says history generally bears that out.
So if the price is really high relative to the actual cash dividend the company pays you, that's another signal the price might be too frothy, anticipating too much future growth already.
Exactly. It's looking at the same overvaluation problem from a different angle. High PE, low dividend yield, both can suggest the price has gotten way ahead of the current reality. These historical patterns from Shiller really hammer home that the go-go years, while culturally unique, fit a recurring pattern of bubbles and their often painful consequences.
And this historical view really underlines the limits of thinking about markets as purely rational places.
Shiller is pretty direct about that.
Yeah.
He argues that financial theories based only on rational investors making logical choices can be so narrow as to be irrelevant for understanding what really happens. He says the reality of today's stock market is anything but test tube clinical.
Yeah, it's messy. Human.
Exactly.
Yeah.
Big market moves, bubbles, crashes. They're usually caused by a whole confluence of factors, not just one simple thing.
So if it's not purely rational actors, what are some of these other factors that conspire to create and inflate these bubbles?
One key mechanism Shiller talks about is what he calls naturally occurring Ponzi processes, or you could call them speculative feedback loops.
Okay, what does that mean? Like a chain reaction?
Pretty much. The dynamic is that rising prices themselves become the reason people buy more. Investors see prices going up, they feel more confident, maybe they regret not buying earlier,
Right.
so they jump in, pushing prices even higher. This attracts more investors who see the rising prices and don't want to miss out. It feeds on itself.
So the rising price justifies itself and pulls more people in.
Yeah, the Ponzi analogy is that investors get rewarded sequentially by price movements, not necessarily by underlying value creation. And this whole loop is often fueled by stories that emphasize the positive news, reinforcing the belief that the trend just has to continue. It's not usually deliberate fraud like a real Ponzi scheme, but the mechanics of new money chasing past price gains are similar.
So the price action itself becomes the story, the justification. What kind of psychological stuff is going on underneath these feedback loops?
Oh, a whole cocktail of biases. One big one is using anchors. When we're uncertain about something's true value, like a stock price, we tend to latch onto some number, any number, as a reference point.
Like the price it was last week or its all-time high?
Exactly. Or even just a round number like $100. These anchors influence our decisions, even if they have no real connection to fundamental value. $90 might feel cheap compared to the $100 anchor, even if the real value is $50.
Oh, I see.
They're also moral anchors, basically. How strongly the story or the emotional argument for investing feels, weighed against how much money you feel you have or need right now. Compelling story plus feeling flush. It's a stronger moral push to invest.
That sounds related to just finding reasons to justify what we want to do anyway.
That's another one. Justification bias. We tend to look for simple reasons to back up a decision we're already leaning towards, even if those reasons don't really hold water logically.
Right.
Like thinking, well, if I buy this stock, then it will go up. Kind of putting the cart before the horse. Or after you've had a winning streak, thinking, I've got a hot hand lately. And using that to justify taking even more risk, regardless of the actual odds now.
And overconfidence must run rampant in a rising market.
Huge factor.
Yeah.
We often make judgments under uncertainty by looking for patterns we think we recognize and assuming they'll repeat. That's the representativeness heuristic.
So if the market's gone up for 3 years, we assume year 4 will be up too.
Pretty much. It leads to overconfidence in our ability to predict the future. Schiller mentions survey data from the '87 crash, where tons of investors were sure they knew when the market would rebound. Even after a massive crash, the overconfidence was still there for many.
And what about just raw emotion? FOMO, fear of missing out, envy?
Oh, incredibly powerful drivers. Schiller talks about the sharp pain of regret you feel when you're sitting on the sidelines watching a market roar higher, watching others seemingly get rich quick.
Yeah, that feeling sucks.
It really does. And that pain, that envy, can push people to jump in, even if intellectually they feel the market is too high or too risky. The emotional cost of not participating feels worse than the potential financial risk. Fear of being left behind trumps caution.
All these psychological factors, anchoring, justification, overconfidence, regret, envy, they seem perfectly designed to create herd behavior.
They absolutely feed into it. And Schiller makes the point that even totally rational people can end up hurting if they start paying attention to what others are doing.
How does that work?
If you see a lot of people buying a certain stock, you might rationally think, maybe they know something I don't, or maybe their collective judgment is better than mine. This can lead to what are called information cascades.
Information cascades?
Yeah, where people start following the actions of others, ignoring their own private information or analysis. Like choosing a busy restaurant over an empty one next door. You assume the crowd knows best.
Right. You follow the herd.
Exactly. And in markets, people start buying because others are buying, creating this momentum that might have little to do with fundamentals. The crowd's action becomes the signal, not the underlying value.
And success breeds more of this, right? If the herd has been right recently.
Definitely. That Statman and Thorley study found high market returns lead to higher trading volume for months afterward. People make money, they feel smarter, more confident, they trade more. It reinforces the herd movement.
And technology has always played a role in spreading these ideas and making the herd move faster.
For sure.
Yeah.
The sources mentioned the telephone back in the 1920s, enabling things like boiler rooms and bucket shops, basically. High-pressure sales, pushing speculative stocks using hype.
The tech changes, but the game stays the same.
Pretty much. Today, you've got email, chat rooms, interactive websites. All these tools can massively expand the interpersonal contagion of ideas. Rumors, hype, narratives can spread globally, instantly, amplifying that herd effect in ways they couldn't have imagined in the 60s, let alone the 20s.
And you mentioned stories earlier. Schiller really emphasizes how critical stories are in driving all this.
He really does. He argues that for these ideas and manias to spread widely through word of mouth, which is essential, there needs to be a good, vivid, tellable story.
Something catchy, easy to repeat.
Exactly. Think about it. Are you going to tell your friends about a detailed analysis of PE ratios? Probably not. But news about a stock that tripled? Or a revolutionary new gadget? Or a genius fund manager? That's a story people will share.
And the scary part is the story doesn't even have to be true to spread like wildfire.
That's Schiller's crucial point. Stories often achieve currency, even though they can be traced to no competent authority whatsoever, or even fly in the face of facts. He gives examples like the myth that we only use 10% of our brains, or that fake story about a baby boom after the '65 NYC blackout.
Right. People believe and repeat stories that sound good, whether they're factual or not.
And in the go-go years, the stories about the inexorable growth of the Nifty 50, the world-changing potential of tronics, the magic of conglomerates, these were incredibly powerful, vivid, tellable stories.
They created a narrative that made the crazy valuations feel okay, feel justified, even if the numbers were questionable.
Totally. People weren't just buying stocks, they were buying into a vision, a narrative about the future. And that narrative got amplified by the rising prices, the social proof of everyone else jumping in, the media coverage. It all fed itself.
Okay, so if we put it all together, you've got genuinely exciting new stuff happening. Tech, business models, easier ways for the public to invest, mutual funds, star managers to follow, these feedback loops where rising prices create more buying, a whole host of psychological biases pushing people towards risk and conformity, herd behavior taking over, technology spreading ideas instantly, and crucially, these powerful, simple, compelling stories. Wow, that's a potent mix.
It really is. A complex brew that can lead to these periods of intense speculation like the go-go years. And while Goldfarb and Kirsch admit there's no airtight science of stock market pricing, they argue that understanding these dynamics is vital, which leads to the question, is there any way for you, the individual investor today, to spot when you might be getting caught up in a similar kind of bubble?
And Goldfarb and Kirsch actually offer a little checklist for that, right? Not guaranteed, but a useful sanity check.
Exactly. A very practical, simple set of 3 questions to ask yourself when you're looking at an investment that feels super exciting, maybe getting a lot of hype. First, is the story particularly compelling or sticky?
Meaning, is it just a really great narrative, revolutionary, something everyone's talking about, easy to tell others? Does it just grab your imagination?
Yeah. Does it have that narrative punch we were just talking about? Second question. Is the story about something that you are familiar with in terms of use or imagination, but in an area that you fail to understand the business well?
Okay. This is key. Like maybe you use the app every day, or you can totally see how this new gadget could change the world. You get the concept, the use. But do you really understand how the company makes money? The competition, the costs, the actual business model?
Exactly. You can picture the cool future, but the nuts and bolts of the business generating the profits, that's fuzzy. You're buying the dream, maybe not the reality of the financials.
Yeah.
And the third question, are there other naive investors in the market? Who is investing in this technology?
Okay. Are your friends who never talk about stocks suddenly experts on this? Is your Uber driver giving you tips on it? Does it feel like maybe the dumb money is piling in, chasing the trend?
Right. And the advice from Goldfarb and Kirsch is pretty direct. If you answer yes to all 3 compelling story, you get the use but not the business, and you see lots of novice investors jumping in then, they say you are in a bubble. Avoid these and save yourself the agony and the loss.
That's actually a really helpful practical tool for you listening right now. It's not about timing the top perfectly, but about recognizing those classic bubble conditions where it's story over substance, and the marginal buyer might be driven more by hype than by careful analysis.
It's a good filter for potentially avoiding a lot of the manias that historically don't end well.
Okay, so let's try to pull the big threads together. What are the most important, enduring lessons from the go-go years that really resonate today for you navigating the markets now?
Well, the most obvious one is just that these cycles repeat. The go-go years weren't some bizarre one-off event. They fit a pattern of booms and busts we've seen over and over, 1901, 1929, the dot-com bubble, others. Just knowing that pattern exists is step 1.
And step 2 has to be valuation matters, period. The go-go years are exhibit A, chasing exciting stories and insane prices, believing growth will just magically fix it. It leads to terrible long-term results. That 26-year wait just to break even from the 66 peak, that says it all.
You just can't extrapolate high growth forever to justify any price. Eventually, reality bites, growth slows, or fundamentals catch up, and prices adjust, often painfully.
And it's not just about the spreadsheets, right? It's understanding the human element. The go-go years show us how crucial it is to understand market psychology, the power of narratives and media, how herd behavior works, the difference between a good story and a good investment. Rational analysis is vital, but it's not the whole picture.
Not even close. And this history becomes even more relevant when you think about how investing itself has changed for most people. You know, the big shift away from old school defined benefit pensions.
Where the company took the risk and paid you a set amount.
For defined contribution plans like 401ks here in the U.S.
Right. That whole shift basically put all the investment risks squarely on the individual shoulders, on your shoulders. Your retirement depends on the decisions you make.
Exactly. And the sources point out some worrying tendencies, like how people often just split their money evenly across whatever fund options are offered in their plan without really looking at what's in those funds.
Which could lead to being way too concentrated in stocks or just poorly diversified without even realizing it.
Yeah. And data shows lots of people, even those close to retirement, have huge chunks of their savings in the stock market, often not well spread out.
So you've got individuals bearing more risk, but maybe not always making the best allocation decisions. That makes them really vulnerable to the kind of big, long downturns that follow these speculative peaks, like the one after 66. The lessons from the go-go years about valuation and volatility are arguably more critical now for individuals managing their own futures.
Absolutely. And finally, there's this idea about investor learning, or maybe unlearning. People say, oh, investors learned their lesson after the dot-com bust or whatever. Lessons like stocks always outperform bonds long term, or diversification is crucial.
But do we really learn, or do we forget?
Well, the sources suggest maybe investors gotten their facts wrong on some of those lessons, like the historical stock bond data isn't quite as simple as stocks always win, or more likely, we're just prone to unlearning the painful lessons over time.
Because the psychological pulls are so strong, the excitement of a new story, the fear of missing out, thinking, this time it's different.
Exactly. Those behavioral factors are always there, whispering in our ear, making us forget the hard-won wisdom of history, tempting us back into the same old patterns of speculation, the belief that the old rules of valuation don't apply this time because of this amazing new thing. It's seductive.
Okay, so let's try to wrap this up. The go-go years of the 1960s. A really potent mix of real economic progress and innovation colliding with wild speculation. It was fueled by exciting new industries, made easy for the public to access via mutual funds and star managers, and then amplified by all these psychological biases, herd behavior, and incredibly compelling but often wildly optimistic stories.
And the lesson, burned into the historical record by those brutal 81% average declines in the glamour stocks, and that agonizing 26-year wait to recover from the 66 peak, is crystal clear. Paying way too much based on hype and hope for future growth is incredibly dangerous. It can destroy returns for decades, even if the initial companies weren't all bad.
And understanding why we collectively fall into these traps, the psychology, the stories, the crowd dynamics, is just as vital, maybe more vital, than just crunching the numbers on a balance sheet.
So we really hope you can take that simple checklist from Goldfarb and Kirsch and keep it in your back pocket. Next time you hear about an investment that sounds unbelievably exciting, ask yourself, is the story too good? Do I understand the product but maybe not the business? And is everyone else piling in?
Because, just like Charles Mackay warned almost 2 centuries ago, and the go-go years proved so dramatically, every age seems to have its own peculiar folly. And thinking about those eerie similarities between the 60s and today, well, the final question is, are we recognizing our own age's folly, or are we maybe already caught up in its madness?
That is definitely something worth thinking about very carefully.
Thanks for joining us for this deep dive into the go-go years. We'll see you next time.